The UK property crisis deepens, what they're still not admitting as the UK property market enters what many experts are describing as one of the most turbulent periods in recent history. The full scope of the crisis remains largely underreported and under-acknowledged by official sources, media narratives, and even industry insiders who have for months attempted to frame the downturn as a temporary correction. At UK Property Info, we have examined the latest data from a range of sources, including the Office for National Statistics, Nationwide, Halifax, property portals, estate agencies, mortgage lenders, and local councils, and the evidence paints a picture far more alarming than what has been communicated to the public. This is not merely a story of falling prices or temporary fluctuations, it is a multi-layered crisis rooted in structural imbalances that have been accumulating for years, now colliding with unprecedented force to reshape the housing landscape. Buyers are increasingly hesitant, sellers are adjusting expectations downward, landlords are leaving the sector in record numbers, renters are facing extraordinary pressure, and policymakers are being forced to confront challenges that have no quick or easy solutions. The first and most visible element of this crisis is the rapid contraction in property values across many regions of the UK. Early year forecasts anticipated moderate price reductions in the range of 2 to 4%, a level that would have represented a manageable correction for both buyers and sellers. Instead, the actual declines are far more severe. In many parts of the southeast, east of England, and Greater London, year-on-year property values are falling by more than 10%, while even traditionally stable regions in the Midlands, North West, and Yorkshire are reporting double-digit price contractions in certain areas. This divergence between expectations and reality highlights not just the depth of the correction but also the uneven distribution of market impacts, which has left buyers uncertain about where and when to make purchases. Analysts are noting that while interest rates remain an important factor influencing affordability, they are not the sole driver of this downturn. More profound forces, such as stagnant wages, inflationary pressures, the depletion of pandemic-era savings, and growing psychological anxiety among potential buyers, are shaping market behavior in ways that are rarely discussed openly. Buyers, when surveyed, often cite uncertainty and fear of further declines as the key reasons for pausing their property searches, revealing a confidence gap that simple price adjustments cannot easily close. Transaction volumes, which typically increase when prices decline, are failing to respond in the usual way. In fact, data from multiple property portals indicates that selling times are lengthening across almost all price brackets, with many homes remaining on the market for 3 to 4 months longer than last year. This stagnation suggests that even with falling prices, the balance between what sellers expect and what buyers are willing or able to pay is widening rather than narrowing. The situation is compounded by shifting mortgage conditions. High loan-to-value ratios are becoming increasingly rare, and stricter lending criteria mean that many prospective buyers cannot access the credit they need, further slowing activity. Lenders, while publicly cautious, are privately noting that default risk is rising and that buyers are more selective than ever before, often withdrawing from deals if valuations do not align with long-term financial projections. One aspect of the crisis that is seldom acknowledged is the regional disparity in market behavior. London, which historically set the tone for national property trends, is experiencing dramatic internal variation. Prime central boroughs are seeing sharper declines than outer suburban areas, where demand remains relatively steadier due to affordability factors. Conversely, cities such as Manchester, Birmingham, and Edinburgh are reporting mixed trends. While some neighbourhoods are seeing slight rebounds in interest, the overall momentum is downward as affordability pressures curb buyer enthusiasm. The gap between urban and suburban, north and south, prime and secondary markets, creates a fragmented landscape where blanket statements about market recovery or stability are misleading at best and dangerously inaccurate at worst. Buyers navigating this environment are effectively forced to make decisions based on hyper-local conditions, something that until recently was a secondary consideration in UK housing reporting. The psychological dimension of the crisis cannot be overstated. For months, analysts and media commentators attempted to downplay the downturn, framing it as a temporary blip or a seasonal adjustment. This messaging, however, has clashed with the lived experience of buyers and sellers on the ground. Confidence surveys reveal that consumer sentiment is deteriorating at the fastest rate in more than a decade, with fears of negative equity, rising mortgage payments, and reduced affordability weighing heavily on decision-making. Even when property prices decline, many potential buyers hesitate, calculating the risk that further reductions may continue, effectively freezing demand in a market where liquidity is critical for stability. Sellers, in turn, are forced to make difficult decisions, accept lower offers now or risk longer-term exposure to declining valuations. The result is a self-reinforcing cycle of uncertainty, with each group waiting for the other to act first, leading to prolonged market inactivity and elevated tension across the housing ecosystem. Adding to these pressures is the ongoing erosion of affordability, which has reached levels not seen in the UK since the early 2000s. Median wage growth has failed to keep pace with either inflation or housing price increases over the past decade, leaving a widening gap between what the average buyer can afford and the market prices being asked. For first-time buyers, this gap is particularly pronounced, with many struggling to amass the necessary deposits or to qualify for mortgages under current lending criteria. Even those who previously benefited from low fixed-rate mortgages during the pandemic face imminent rate resets that could significantly increase monthly repayments, adding another layer of stress and uncertainty. The interplay of these economic, financial, and psychological factors paints a picture of a market in flux, where conventional strategies for stimulating activity, such as interest rate cuts or government incentives, may have only limited effect. Finally, the role of official messaging in shaping perception warrants attention. Public communications from policymakers, financial institutions, and industry bodies have largely focused on downplaying risk and projecting optimism. Statements often highlight minor price stabilizations or isolated instances of market resilience, giving the impression that the crisis is manageable and temporary. What is not being admitted, however, is that these isolated data points mask broader structural vulnerabilities. The market correction is deeper, regional imbalances are intensifying, transaction volumes remain subdued, and consumer confidence is at historic lows. At UK Property Info, we emphasize that acknowledging these realities is critical. Without a clear-eyed understanding of the forces reshaping the market, buyers, sellers, landlords, and tenants are navigating uncertainty with incomplete information, leaving them vulnerable to decisions that may carry long-term financial consequences. The UK property crisis is, at its core, a convergence of affordability pressures, regional imbalances, weakening demand, psychological uncertainty, and structural vulnerabilities that have been building for decades. What is happening now is not merely a market correction, it is a recalibration of the housing ecosystem, one that will have profound implications for years to come. For buyers, the challenge lies in assessing risk amidst volatility. For sellers, the task is to recalibrate expectations realistically. For landlords, strategic exits may become increasingly necessary, and for renters, the competition and cost pressures are intensifying. Policymakers face the monumental task of addressing systemic weaknesses without further destabilizing an already fragile market. At UK Property Info, we aim to bring clarity, depth, and insight to this evolving situation, presenting the full context behind the numbers, trends, and narratives that are too often oversimplified or ignored in mainstream reporting. While falling house prices dominate the headlines, the hidden forces shaping the UK property crisis are perhaps even more consequential, particularly the dramatic exodus of landlords from the private rental sector. For decades, private landlords served as a backbone of the housing market, providing critical rental stock for millions of tenants and supporting stability across urban and suburban areas alike. Yet today, this cohort is retreating at a rate not seen in modern history. The reasons are multifaceted and interlinked: increasing mortgage costs, heightened regulatory demands, additional tax burdens, rising maintenance expenses, and the growing complexity of compliance obligations are creating a business environment in which profitability is no longer guaranteed. Many landlords, particularly those with smaller portfolios who relied on rental income to supplement their earnings, are finding the risk-reward balance untenable. As a result, large numbers are deciding to sell their properties, sometimes en masse, in order to reduce exposure and protect their financial positions. What is rarely admitted publicly, however, is that this trend is directly intensifying the rental crisis, creating a situation where shrinking supply meets escalating demand with severe consequences for tenants. Across major urban centres, competition for rental properties has surged to unprecedented levels. In London, Manchester, Birmingham, Edinburgh, and other populous cities, tenants now face conditions that mirror speculative housing markets, with multiple parties bidding for the same property, often offering higher than asked rents or months of rent in advance simply to secure a lease. Areas previously regarded as affordable are increasingly unaffordable, and tenants with modest incomes are being forced into either shared accommodation or increasingly long commutes, fundamentally altering living patterns and lifestyle choices. Smaller regional cities, historically viewed as alternatives to high-cost metropolitan areas, are also experiencing rising rents, albeit at a slightly lower pace, indicating that the pressures on the rental market are widespread rather than isolated. For younger renters, families with limited income, and first-time renters in particular, these dynamics are creating a precarious situation that may persist for years unless intervention occurs. Meanwhile, sellers are confronting their own set of challenges. Those who purchased homes during the post-pandemic boom years of 2020 to 2022 expected either stable or appreciating property values. Instead, they are now experiencing significant down valuation. Surveyors increasingly report that properties are being assessed at values well below sellers' expectations, forcing homeowners to make difficult choices, accept lower offers to complete a sale, or risk prolonged market exposure while waiting for prices to stabilize. Many sellers, particularly those with mortgages tied to higher purchase prices, face the unsettling reality of negative equity, a situation reminiscent of the early 1990s when the UK market first encountered similar structural vulnerabilities. This has created a psychological and financial strain across the housing ecosystem, as both buyers and sellers hesitate, waiting for the other side to act first, which in turn exacerbates market stagnation. Interest rates, often portrayed as the central cause of market volatility, are only part of the explanation. While it is true that rising borrowing costs have reduced the pool of eligible buyers, they are not the sole driver of declining activity or the drop in prices. Even if rates begin to fall in the near future, affordability challenges will remain due to stagnant wages, higher living costs, and accumulated household debt. Many buyers, particularly first-time purchasers, face a structural barrier that will not be solved by lower interest rates alone. The gap between average earnings and the cost of even modest homes has reached historic extremes, leaving millions unable to enter the market regardless of rate adjustments. Analysts warn that any rebound in activity will likely be slow, fragmented, and heavily regional, as buyers selectively target areas they perceive as offering both value and future stability. The impact on landlords and rental stock also feeds directly into the sales market. As rental properties are sold off, the pool of available homes for tenants shrinks, driving rents higher and creating an indirect pressure on potential buyers who may otherwise have opted to rent temporarily while saving for a deposit. Families and individuals face escalating choices: pay increasingly high rents, extend their time living in suboptimal conditions, or delay entry into the housing market entirely. This dynamic creates a feedback loop in which demand for owned properties diminishes further, prolonging price reductions and keeping market liquidity low. Market analysts have described this as a compound crisis, where issues in one segment rental supply intensify problems in another segment sales, ultimately affecting the broader stability of the housing sector. Another crucial but understated aspect of the crisis is the effect on housing transactions in general. Listing durations are increasing across almost all price ranges, reflecting the widening gap between what sellers expect and what buyers are able to pay. Estate agents report that while some properties continue to attract interest, the number of completed sales has fallen sharply, particularly in regions with higher price points or elevated borrowing costs. In lower-priced areas, while demand remains relatively resilient, affordability limits still slow the pace of transactions. This uneven distribution of activity underscores a broader trend. The UK property market is no longer a uniform entity but a series of interrelated micro-markets, each with unique pressures, performance metrics, and outlooks. Adding to these pressures is the growing wave of forced or distressed sales. Many homeowners who secured low fixed-rate mortgages during the pandemic are approaching the end of their term and facing significantly higher repayments. For those unable to absorb the increased financial burden, selling becomes a necessity rather than a choice. Legal advisors, mortgage brokers, and financial consultants are quietly reporting a notable rise in inquiries about early sales and financial restructuring. While the data is only beginning to reflect this phenomenon, the underlying trend indicates a looming wave of market activity driven not by opportunistic buying or selling but by financial necessity, a factor that has yet to be fully acknowledged in public reporting. In addition, the construction sector, a vital component of housing stability, is struggling to respond to current market needs. Developers, confronted with higher borrowing costs, slower sales, and uncertain demand, are pausing or delaying projects, reducing new build output at a time when supply shortages could exacerbate price volatility. The combination of slowed construction, rising rents, and declining sales creates a multi-dimensional challenge that affects every stakeholder in the housing ecosystem, from tenants seeking stable homes to first-time buyers attempting to enter the market, to policymakers tasked with maintaining overall economic and social stability. The overall picture is clear: this is not a minor correction or a temporary setback. The UK property market is experiencing structural recalibration on multiple fronts, with rental pressures, declining buyer confidence, financial strain on homeowners, and developer retrenchment converging to create a situation of profound uncertainty. At UK Property Info, our focus is on providing transparency and clarity, bringing to light the realities of the market that are often minimized or overlooked in conventional reporting. The landlord exodus, the shrinking rental stock, the rising rents, and the negative equity pressures are interconnected factors, each amplifying the others, resulting in a crisis whose implications will continue to unfold throughout 2025 and likely beyond. Understanding these dynamics is crucial for anyone involved in the property market, whether as a buyer, seller, landlord, tenant, or policymaker, because the consequences of inaction or misunderstanding could be significant, with financial, social, and economic ramifications that extend far beyond the immediate market fluctuations. Meanwhile, the pressures on renters, homeowners, and the broader housing market continue to intensify, creating a situation that is both complex and deeply concerning. Tenants across the UK are feeling the full weight of the crisis as rental stock continues to shrink due to the ongoing landlord exodus and the reduced pace of new construction. In major cities such as London, Birmingham, Manchester, Edinburgh, and Glasgow, competition for available properties has reached unprecedented levels. Bidding wars are now a common feature of the market, with tenants offering months of rent in advance or paying significantly above listed prices to secure a home. Even in traditionally affordable regional cities, rent increases are outpacing wage growth, creating a financial squeeze that is forcing families to compromise on quality, size, or location. Younger renters, particularly first-time renters, are disproportionately affected, with many returning to shared accommodations or moving back with family members simply because independent living has become financially unattainable. The human impact of this trend is profound, with long-term consequences for social mobility, employment patterns, and overall quality of life. Yet despite the severity of these pressures, public discourse often minimizes the challenges, focusing instead on optimistic narratives or isolated signs of market resilience, failing to acknowledge that the underlying structural imbalances remain unresolved and are in fact worsening. At the same time, homeowners face a growing wave of financial strain as fixed-rate mortgages secured during the pandemic approach expiration. For many, the transition to higher repayment rates is not a manageable adjustment but a potential crisis. Financial advisors, mortgage brokers, and legal consultants report a rising number of inquiries from homeowners exploring early sales, renegotiation of loan terms, or debt restructuring in order to avoid falling into arrears. The resulting increase in distressed or forced sales will place further downward pressure on property values, compounding the existing market downturn and creating additional uncertainty for buyers and sellers alike. This is a dimension of the crisis that is rarely reflected in mainstream reporting but has significant implications for market stability and liquidity. The combination of rising interest rates, extended mortgage terms, and the broader economic slowdown means that homeowners are now navigating a highly volatile environment where both short-term decisions and long-term financial planning are critically affected. The construction and development sector, another cornerstone of housing stability, is also experiencing significant disruption. Developers are confronted with a market that has cooled sharply, financing conditions that are less favorable than in previous years, and demand levels that are both uncertain and unevenly distributed across regions. Many new build projects have been paused, delayed, or indefinitely shelved, reducing the influx of new housing units at a time when supply shortages could exacerbate price and rental pressures. This slowdown threatens to extend the crisis into the medium term because insufficient new housing supply will continue to limit options for buyers and renters alike. Analysts warn that while interest rate reductions or temporary government interventions may provide short-term relief, they are unlikely to resolve the fundamental supply-demand imbalance that is driving much of the current market tension. The interplay of these pressures: falling property values, distressed homeowners, landlord exits, rising rents, stagnating construction, and fragmented regional performance creates a market environment of unprecedented complexity. Each element influences the others, producing feedback loops that amplify challenges across the system. For example, as landlords sell properties, rental supply diminishes, driving rents higher, which in turn may encourage more homeowners to remain in their properties rather than rent them out, further exacerbating supply constraints. Simultaneously, negative equity pressures force some homeowners to sell, increasing supply in certain segments while reinforcing uncertainty about pricing stability. This interconnectedness highlights the necessity of understanding the housing market not as a single entity but as a web of interdependent submarkets, each responding to overlapping economic, financial, and social pressures. Looking ahead, the trajectory of the UK property market appears unlikely to follow a smooth recovery path. Analysts are forecasting continued volatility, with periods of marginal stabilization punctuated by sharp corrections in specific regions or market segments. First-time buyers will continue to face significant barriers to entry, middle-market sellers will struggle to reconcile price expectations with market realities, and tenants will confront elevated rents and fierce competition for limited housing stock. Policymakers are confronted with the formidable challenge of addressing these systemic imbalances while avoiding unintended consequences that could worsen market conditions. Structural interventions, such as incentivizing new build construction, reforming taxation and landlord regulations, and supporting affordability measures for first-time buyers and low-income renters, may be necessary to restore balance over the medium to long term. However, these measures take time to implement and their effectiveness will depend on careful coordination with broader economic policies and market forces. The UK property crisis, as it stands today, is therefore multi-dimensional, systemic, and evolving. Its impact extends beyond simple price adjustments to affect the lives of millions of residents, the viability of landlords, the stability of financial institutions, and the functioning of local and national economies. What is most striking, and least acknowledged publicly, is that the underlying vulnerabilities have been accumulating over decades and are now converging to create a situation that will not be resolved quickly or easily. At UK Property Info, we are committed to providing our audience with a clear, comprehensive, and evidence-based analysis of these trends, highlighting both the immediate developments and the longer-term implications for all stakeholders in the housing market. Our focus remains on transparency and clarity, bringing to light the realities that are often overlooked or downplayed in mainstream reporting, and ensuring that buyers, sellers, renters, landlords, and policymakers are equipped with the knowledge they need to navigate this turbulent period. In conclusion, the UK property market today is far from a temporary blip or minor correction. It is a structural recalibration driven by the interaction of falling property values, financial pressures on homeowners, exodus of landlords, rental shortages, construction slowdowns, and shifting consumer confidence. Understanding these interconnected forces is essential for anyone involved in the housing market, whether as an investor, homeowner, tenant, or policymaker. The crisis is ongoing, its effects are profound, and the solutions are complex, requiring a combination of realistic policy interventions, financial prudence, and careful navigation by all market participants. At UK Property Info, we will continue to report with accuracy, depth, and insight, ensuring that our audience fully comprehends not only what is happening but why it is happening and how it may evolve in the months and years ahead.